Hey, good morning. This is Julie. Take a look at the football field for Ohio State. They have a new field that they're going to be rolling out. Looks pretty good to me. Um, I'm bringing you the football field as an analogy that, it is about how we slice and dice data to determine if we're going to um, trade a certain location and go a certain distance during a certain time period. And if you can figure that out, then you might have a chance at turning your balance sheet in the right direction, and that's what we want to do. So, let me use some football fields, show you the volume. This is our football field. It shows you shares traded, what the amount of liquidity is in the market, trade liquid markets that has plenty of participants so that you won't have any trouble getting in and out. You'll notice recently the volatility has been very low, as well as the volume. So low volume equals low volatility, right? They're correlated. So we've had about 13, 14 million futures traded, options about 2.73. And what I found very interesting, you can come on the CME's website and look at these daily reports or monthly, aggregate the reports and get historical data. The micros are really picking up. Here we go. So here's the E-mini, 34 million contracts volume in July. Um, but take a look down here at the micros, 25.3 micros. That's almost as much. I mean, it's closing in on almost 100%. Look at the NASDAQ. The 26 million exceeds the futures regular contract by 2 to 1. So the money is moving to the micros. And I'm thinking that they're using the micros like options now because you have to put a lot of risk on the table for a long time with the options for little premium. So I was like, that's sort of crazy, isn't it? But anyway, if you know where to pick your spots on the football field, it might help. So where you position yourself in on the daily volume is very important. So I look because the option is about 30% of the market. I look at the pricing sheet for my contract and familiarize myself. This is the quarterly expiration. There are less than a month, 27.59 days left. So we're right at the monthly quarterly expiry that will be very important coming up. So the mean we're sitting on right now, 42.30. So think of zero to infinity. We're sitting at target zero. So we can move out to the range, and that's where we look to see where those end zones are going from the first to the second standard deviation and mark those levels on the chart, which I've done for you, 40.35 and 44.30, as well as put the mean of the quarterly options using Black Scholes. You can use different models. I'm using just Black Scholes. And you can notice also where high gamma is. So that's ranging from about 42.95 to 42.65. So I like to put a high gamma Here we go. There is our high gamma range. So we've broken away from it, went to touch the mean, and we're in the middle of the quarterly distribution. So literally flip a coin, right? 50-50. There are a few things that you'll want to see, including real volatility for um, historical volatility, which is sort of like the unknown factor that everyone wanted to see in the options world. And here that is. Here's the quarterly distribution. And you can see that this is often the location that price actually responds to. There's the 3, and again, here's the 3. So the 3 doesn't get challenged that much. It's kind of a like 3 bounce right up off the 3. It's a rare event, and we've had the correction from the beginning of the year, right? So if I go back and show you past patterns, you can see it got nowhere even close to it. Stopped at the 2. This was March, and it went one time the entire distribution. See how algorithmic the market is, going to the real volatility levels. But as you can see, it, here was a couple of other instances where it broke it, went to the statistical levels and bounced. So you can, organize this statistically, and that's what I have done, and get some outliers that way. Know where you are in the distribution at the time. Very hard to be buying when everything is going red, 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 right? And the worst of the news is happening, and people don't realize though that you're at a very significantly um, statistically significant level. So spit it out. Okay, so we're at the 1, and the 1 is where if you're going to be selling, they do, right? If you're in a bear market, you sell the 1, so you're now selling calls, right? So that's what they're doing, and you would expect that that is going to have to break clearly for any hope of a future price rally. So here is your mean for the options that we're sitting on, and I can add more contracts. Let me get these arrows off. Let me add more PT levels for more weekly, monthly. I'll show you the month first. Here's the monthly, and you can see we broke it, but it sat on that level for a week before it broke on Friday. But it stopped cold, could not go further, and that is because it was pinned with the weekly, which is right here, right there. So the weekly is where the market makers and dealers put their risk, selling their puts right there. So the market was in a tight range inside this risk box, and we're still in that range. It hasn't broken yet. If the range breaks, it'll be a clear shot towards the lower end of the range with 2 little bumpers in the middle. If it floats back up, if the volatility stays low and reverses back up, there's some good literature from published by the New York Federal Reserve. So it indicates that once a market has an extended greater than one standard deviation move during a RTH session, that there's a good chance that the market makers will need to offset that risk, and they do so often in the overnight session. So I guess they sprinkle it out a little bit in the Asia Open, but primarily the London overnight drive time. And they give the information in their paper. It was great. So I put together a bloodhound template to show that distribution and show how you can get custom intraday ranges as well. And I'm going to show you that right now. Okay, so here is the chart with the PT indicator ranges for the London session. And it's a pretty good distribution, lays out very algorithmically with the statistical levels. The New York Fed's paper said that it was highly statistically significant market, and it looks like that is absolutely correct. Absolutely correct. And so the London Open is the yellow dash line. The Globex Open is the pink line. The RTH Open is the orange line. And we can see that when the London Open holds, that pretty much sets the direction for the foot. Oops, wrong. I need to get the arrow. So here's your London Open, and there's your range. So how far do you know to go, right? Well, I have, here's a template with the PT2 on the market analyzer, and sorry about that. Okay, so you can see how far to go. So in the London session, um, it will tell you, you can set the column time yourself. I set my London session, move that up to 3 to 4. So if I wanted to move it to 2 to 3, I could do that, but this is for Central Time. And so there's your London Open, and that will tell you how far to expect price to go on average during the low, medium, or high volatility, as well as the entire Globex period, or I can break down the Asia session. And the RTH session, I can break down the 1 hour IB, as well as the first 30 minutes, 15 minutes, and 5 minutes of the trade session, or just give you the daily range. So that's how far on average we can expect the market to go, diced all the way down into these nice little levels for us. And then we can look at our chart, and here's the Globex drift template that I put together showing these ranges with Bloodhound, my little Bloodhound template. So you can do basic little quick things like this very, very quickly, less than 10 minutes working on this chart. So I like the concept. I was like modeling from the paper of the New York Fed. It looks pretty good. They know what they're talking about. So this seems promising. I'm going to start paying attention to this template more, but you can put these custom ranges together extremely quickly, whatever distributions you would like to have, um, and change them so that you can see different variations. time periods that you're interested in. And the goal, right, for any endeavor is to buy low and sell high. And knowing when you're in the middle of the value range or outside, breaking the range and expanding out. So the PT2 indicator helps me with that tremendously. I can tell by the slope whether my range is expanding or contracting. Very simple. If I'm in a contraction, like right here in this sell-off, which we have been seeing in these bear market sell-offs on low vol, it doesn't go far. So you can pretty much stick to your standard indicator. So I'll put the Globex range on here, distribution, show you what I mean. And right here, it traded to the Globex distribution precisely. See that? Very algorithmic. So just be aware of where you are. If you're in a low vol situation, you want to be taking your profits at your target and not expecting a further breakout. Um, this low vol on the one, you could see they were buying it. So this template, I I just threw this together to show the directional move out. I haven't optimized the template to show current volatility, which I can do also. Um, but be aware of the volatility situation that you're in. Friday, we were directionally short, but in that very low vol. So they were buying levels and not selling it. Let me put the daily on here. That's the Globex. Put the daily close and the open because we can do both. Okay. Here we go. So that was Friday. Oops. It was a sell off. It was low vol. So you just had to be careful. It didn't go far. There was a weekly one right below it. And given that it was Friday, always check your weekly levels. Right there. So they didn't allow price to even get close to it. And from what my empirical studies of past charts has been, that when support is bid like that and you can't even get close to the target, a lot of the times you'll see that reversal off the level. So I'm just saying I would not be shocked if this turned back up. But this 42.12 is my line in the sand for further shorts. And if we get that further shorts, there's going to be a long way to go. And we can go inside the quarterly that we saw on the other chart. Come into the 41, 44, 40, 90 area. And if we go back up, then we are going to be hitting that monthly one again, and I'm almost expecting to see it turn back down if we do get that last retest. So, pretty sure, because the quarterly one was being sold, that we might see some downside action, but we have to break the 42.12 before any of the party starts. Otherwise, it's just inside the ones, and they can eat the theta till the cows come home. They don't care. They'll just put it in that tight little range and cash their premium checks. All right. So now we know what they're doing. We just have to figure out how to position ourselves inside these distributions. And I really like this London distribution. That's what this is, setting up the London time frame open. And I can see that it is respected. They buy that one, right? Comes back, respects, goes back off. So these little tiny distributions work just like the big ones. It's 1, 2, 3 out into the tails, 1, 2, 3 out into the tails. So, and here was your Globex. So I do like the template a lot. I'll be definitely checking this when I do my Globex review. And the, like on the other chart, I do want to put a Globex distribution on the open and close. And that fills it in much better. Yep. So that gives you more clues of where these turning points can be, and just rely on the algorithmic nature of the market and where they are relative to these distributions. So we've got the Asia open, and I can do that also. I can do a distribution for Asia, can do this for London, and I can do it for the RTH open. So I can have like three opening range distributions to look at. Um, might get a little busy putting them all together on one chart, but definitely maybe set up different tabs, one with the London, one with the RTH, one with the Asia. Get your bases covered, and then have your template going forward. How are you going to look at it with your higher time frame, monthly, quarterly, weekly review? Because that is the overall picture where you're going to go on the football field, and then having the distances. So with the London session running about 10 points, 9.5 points for that 1 hour opening balance, we can get our little ruler out and measure it. So there's 6. So there's 10 points. So in the London session open, you can go from the middle of the open up and down 10 points as your target. And you can do the same thing with the other distributions using the open. So there was my London target to trade to. So we open in the middle of the distribution right here, and trade to your targets right here. Target reached, went under it and came back in. And then beyond, of course. RTH opened over here, and we were no longer in the London. We need to put the RTH open on here, so let's do that real quick. Okay, right here. The yellow is our distribution, and here was the break. Right there. Right to a tail. And then to your Globex. The weekly, like I said, was the pin. They pinned the market. So just having an ability to measure the range, the RTH was 44.45. So you could measure from the open down. So there's 39.25, and there's 44. You can see that it didn't get to the range almost. It was blocked, but very close. Um, and that was the full range. So I always trade to the easy target to reach, the 3181, trade to the twos, and that would have been hit the side of a barn, right? So there you go. Easy target. But it's nice having the points of the past historical record of what the range is traded to on the statistical levels, and create your templates accordingly. I can create several different methodologies for capturing the RTH session, or the Globex session differently. Um, and you should be using Bloodhound to do the same. Here was my template Friday. It was smart. It did not participate for the rest. All right. So that's it for now. Thank you very much, and we'll talk to you later.